It was a Monday morning in September 2008. Lehman Brothers had just filed for bankruptcy. Within 5 days, $10 trillion in global wealth had disappeared. Pension funds were collapsing. Banks had stopped lending to each other. Ordinary people were watching their retirement accounts cut in half in real time. In a trading room in Midtown Manhattan, one fund manager was looking at a $15 billion profit, not despite the crash. Because of it. His name was John Paulson. The instruments he used were so far outside mainstream financial conversation that most individual investors still don't know they exist. More than 15 years later, here's what most financial advice gets wrong about economic crashes. It tells you to protect yourself. Go to cash, go to gold, wait it out, survive. That thinking is exactly why average investors lose twice. Once during the crash, when their portfolio bleeds, and again during the recovery when they re-enter too late and miss the biggest gains. Crashes do not destroy wealth. They transfer it, every single time, through the same predictable channels. And once you understand those 5 channels, you stop being the person on the wrong side of the transfer. Let's start with the first one, and it's the one that surprises people the most. Long-duration government bonds. Most people treat bonds the way they treat a visit to the dentist. They know they probably should own some, don't fully understand them, and they'd rather not think about it. That attitude is expensive. Because long-duration bonds don't just hold their value during a financial collapse, they generate real, substantial returns. Here's the mechanism. When an economy starts deteriorating, central banks respond with one tool above all others. They cut interest rates, fast and hard. In 2008, the Federal Reserve slashed rates from 5.25% to nearly zero in 14 months. In March 2020, they cut by 150 basis points in a single emergency weekend session. When interest rates fall, something mathematical and ruthless happens to existing bonds. A government bond that was issued paying 4% annual interest becomes extraordinarily valuable the moment newly issued bonds only yield 1%. The older bond is now a premium asset. It's not by a small margin, by a large one. In 2008, while the S&P 500 fell 38%, the iShares 20-year Treasury bond ETF gained 33.8%, not stayed flat, gained. In the middle of the worst financial crisis since 1929. Go back further to the Great Depression, from 1929 through 1932. As the stock market lost 89% of its value, long-term U.S. government bonds returned positive gains every single year. For consecutive years of collapse, bonds climbing through all of it. The 2020 pandemic crash was the clearest modern demonstration of this. In the weeks before the March bottom, long-duration Treasury bonds gained approximately 25% in under 6 weeks, as equity markets fell 34%. Anyone who understood this relationship didn't just have a hedge, they had an actively returning instrument during the most intense phase of the crash. The window for this trade is specific. It opens when fear of deflation replaces fear of inflation in the market. Usually when credit markets first begin to seize up. It closes when central bank intervention triggers inflation expectations. The investors who know when that window opens are sitting on gains. While retail investors are still reading about the crash in the news, the second asset is one that most people have never considered owning at all: volatility itself. The VIX is the Chicago Board Options Exchange Volatility Index. It measures how much fear exists in the options market for the S&P 500. When markets are calm, it sits around 12 to 15. During a genuine crash, it does something that looks almost impossible on a chart. In February 2020, the VIX was sitting at around 14. Markets were at all-time highs. The general mood was complacency. By March 18th of that same year, the VIX hit 85.47. That is a 507% increase in 6 weeks. In October 2008, it reached 89.53, up from roughly 20 at the start of the year, a 347% move. These are not modest fluctuations. They are seismic. And unlike most assets, volatility doesn't just move during a crash, it explodes. What most people don't know is that you can actually own volatility as a financial instrument. Exchange-traded products linked to VIX futures have existed since 2009. During the 2020 crash, these instruments generated returns that sound impossible until you pull up the actual charts. John Paulson's legendary 2008 trade was at its core a structured bet that volatility would detonate in the mortgage market. He bought credit default swaps, a form of insurance against bond defaults, at a moment when the market was pricing volatility near zero. When the equivalent of the VIX in the mortgage world exploded, his $1 billion position became $15 billion in profits. The constraint here is timing. These instruments decay slowly during calm, low volatility periods. They are not designed to be held passively. They are designed to be deployed surgically during the specific window. When credit begins to crack, and before the mainstream media has caught up to what the options market already knows. The third asset is the one institutional investors have used to build generational wealth during every major collapse in modern history: distressed debt. Here is the mechanism. During a crash, forced sellers appear everywhere at the same time. Banks managing capital requirements, hedge funds hit with redemptions, insurance companies under regulatory pressure. These sellers are not analyzing recovery value. They're managing immediate survival. They will sell a bond with a 90-cent recovery value for 30 cents if the alternative is insolvency. March 2020 created the purest recent example of this. Investment-grade corporate bonds saw prices crash 20% in 3 weeks. Not because those companies were failing, because panicking institutions needed cash immediately and were selling anything that could be sold. From the March 2020 bottom through December of that year, investment-grade bond funds recovered approximately 25%. High-yield bonds performed even more dramatically, falling 24% in the crash, then returning roughly 40% from bottom to peak within 7 months. Howard Marks, who runs Oaktree Capital, wrote to his clients in October 2008 that the opportunity set was the most compelling he had ever encountered. Oaktree's distressed debt funds, launched in 2007 and 2008, generated average annual returns of over 20% for the following 5 years. The pattern reaches back through every major crisis. After the Latin American debt crisis of 1982, investors who bought defaulted Mexican sovereign debt at 15 cents on the dollar made several 100% returns. After the Asian financial crisis of 1997, after Argentina's 2001 default, the mechanism is identical every time. Fear creates pricing that is completely disconnected from actual recovery analysis. Institutional investors with patience absorb that mispricing. Retail investors, taught to avoid anything below investment grade, never participate. The entrance signal is always the same. High-yield credit spreads over treasuries that normally sit around 300 to 400 basis points widen to 800, 1,000, 1,200. At that level, the market is pricing in a default rate that implies most of the economy is insolvent. In a modern economy, with a functioning central bank that has never happened, the trade is buying what panic prices as if civilization is ending and holding it until reality reasserts itself. The fourth asset is the one almost everyone believes they understand: gold, but almost no one understands when to actually buy it. Here's the mistake most investors make. They buy gold before the crash, expecting it to protect them during the crash. It frequently doesn't. In 2008, gold peaked at around $1,000 per ounce in February. By October, it had fallen to $720, a 28% drop during the worst financial crisis in 70 years. Investors who bought gold as a crisis hedge and panic sold in October didn't just fail to protect themselves, they lost money. Gold's real function during a crisis is not to protect against the crash itself. It is to protect against the government's response to the crash. Against the emergency rate cuts, the money printing, the balance sheet expansion that follows every major financial collapse like dawn follows darkness. From its October 2008 low of $720, gold rose to $1,900 by September 2011, a 164% gain, not from before the crash. From the bottom of the crash, after most emotional investors had already sold it in disgust, the mechanism is direct. The Federal Reserve's balance sheet expanded from $900 billion to $4.5 trillion over 4 years. In 2020, it went from $4 trillion to $9 trillion in just 8 months. When the monetary base expands at that velocity, every existing unit of currency represents a smaller claim on a fixed pool of real assets. Gold, which cannot be printed or created by legislation, appreciates proportionally to the expansion of the money supply. The correct time to buy gold is not at the market top before the crash. It is at the bottom during the crash, when panic selling has temporarily disconnected its price from its fundamental role, and central banks are clearly beginning their monetary response. That window has opened in every major crisis in modern history. It has rewarded patient buyers every single time. The fifth asset is the only one on this list that is genuinely independent of the financial system itself: agricultural land. Between 2007 and 2012, the median U.S. home price fell 26%. Commercial real estate dropped 30 to 40% in major markets. The diversified stock portfolio was cut in half. During that same period, U.S. farmland values rose by an average of 30%. This is not a coincidence. Soybean field in central Illinois does not care whether Lehman Brothers is solvent. It produces soybeans. Those soybeans feed people. People need to eat, regardless of what the bond market is doing. The USDA tracked Iowa farmland values with precision through the 2008 crisis. Average Iowa farmland value in 2007 was approximately $3,900 per acre. By 2012, it had reached $8,400, a 115% gain, while the broader financial system was experiencing its worst contraction in 70 years. Go back to the 1930s. The Great Depression is remembered for breadlines and mass unemployment. For farmers who owned their land outright and carried no debt, it was a fundamentally different experience. They maintained food security. They traded produce. They sat on land that, despite Depression-era price pressure, retained its productive value in ways no financial instrument could replicate. The deeper truth is this: long-duration bonds require functioning central banks. Volatility instruments require operational derivative markets. Distressed debt requires a legal system that enforces recovery contracts. Gold requires a global market to price it. Farmland requires soil, water, and biological processes that have been running for 4 billion years. No. Government bond has that track record. Here's the conclusion that every economic crash in the last century confirms without exception: the money lost in a crash is not destroyed. It changes hands. It moves from the unprepared to the positioned, from the reactive to the structural, from the people reading about the crisis in the news to the people who understood the mechanics before the headlines arrived. Long-duration bonds that surge on deflation fear before central banks announce their first rate cut. Volatility instruments that explode at the precise moment retail investors are most confused. Distressed debt that panicking sellers abandon at fractions of recovery value while institutional buyers absorb it in silence. Gold that lags the crash and then doubles on the monetary response that every government in history has been unable to resist. And farmland that quietly outperforms while the financial system collapses around it because the land doesn't read the news. The investors who profited most from 2008 were not geniuses. They were not insiders. They were people who had understood these mechanics before the crisis arrived. Every crash in history was called unprecedented by the people it destroyed. It was called entirely predictable by the people who had positioned for it. The difference between those two groups has never been intelligence. It has always been preparation.